I am pleased to welcome Andrew Felton, the Director of the Division of Insurance and Research at the FDIC. In that role, he oversees management of the Deposit Insurance Fund, research, economic analysis, and international coordination. He previously served as a Deputy Director for Systemic Risk in the FDIC's Division of Complex Institution Supervision and Resolution. Andy joined the FDIC in 2005 and has also worked at the Federal Reserve Board of Governors. So with that, Andy, welcome to the 2025 Community Bank Research Conference. Thank you.
Thank you, Jim. So I learned this morning that the main new threat vector is voice spoofing. And so I'm a little nervous that if this is being recorded, it will be used by AI to hack into my accounts. But don't worry, I have two-factor authentication on all of my apps. So hopefully I'm safe. Anyways, good afternoon, everyone. It's a pleasure to be here in St. Louis at the 2025 Community Banking Research Conference. I would like to thank our hosts, as many other people have done so far. So thank you to Jim and the rest of the Federal Reserve Bank of St. Louis team, Brandon and the Conference of State Bank Supervisors, the Federal Reserve System more broadly, and also to my colleagues at the FDIC for convening what has become really one of the most important conversations on community banking every year. I've heard great things about this event over the years, and it's an honor to be with you in person here today. So anyways, as Jim mentioned, my name is Andrew Felton. I'm the Director of the Division of Insurance and Research at the FDIC. And in that role, I spend a lot of time thinking about how research, data, and analysis can help us protect depositors, safeguard financial stability, and support the community banks that anchor our financial system. As you already know, this conference is unique. It's one of the few places where bankers, academics, supervisors, and policymakers sit down together to share perspectives, discuss evidence, and engage in constructive dialogue. This combination of rigorous research and real-world experience is powerful. It ensures the topics we debate are grounded in data and thoughtful analysis, but also connected to the lived reality of community banks across the country. This afternoon, I'd like to share with you my perspective on how research informs sound banking policy and how partnership among bankers, researchers, supervisors, and policymakers ultimately helps us all strengthen the financial system. These three themes, research, policy, and partnership, run through the very core of the FDIC's work and will frame my remarks today. The importance of research to the FDIC's mission goes back to our earliest days. In 1934, the corporation's first full year of operation, a research unit was established to collect data on the condition of banks, study the history of depositor losses, and analyze efforts to stabilize the financial system. That early commitment to evidence has remained a defining feature of the FDIC for more than 90 years. Today, research is not separate from our mission. It's embedded in everything that we do. It ensures our policies are grounded in evidence, our supervision is focused on material risks, and our actions build confidence in the banking system. Let me briefly highlight some of the ways the research continues to shape our daily responsibilities. First, research provides the analytical foundation for protecting the Deposit Insurance Fund. We use models to estimate potential losses, guide provisioning, and calibrate risk-based assessments. These tools help ensure that the fund is strong enough to weather stress and continues to provide the protection that depositors expect. Second, research strengthens supervision. Our analysts develop monitoring tools that combine bank, market, and economic data to identify early warning signals. These tools help examiners target their time and resources more effectively and keep the supervisory focus on core financial risks. Third, research supports policymaking. Every major FDIC rulemaking is accompanied by research that weighs costs, benefits, and potential unintended consequences. By drawing on call report data, summary of deposits data, and surveys, we assess how policies may affect institutions of different sizes and the broader economy, with the aim of regulation to be both evidence-based and proportionate. Fourth, research prepares us to manage and resolve crises. When a bank fails, decisions must be made quickly and under pressure. Long before that moment, research helps us understand the implications of alternative resolution strategies, fund management through the cycle, and the possible effects of a failure on local communities. That advanced work allows us to act swiftly, to protect depositors, and minimize losses to the fund. And fifth, research helps us stay abreast of emerging risks. New products, evolving market structures, and unexpected events often challenge our traditional frameworks for assessing risk. Research equips us to evaluate when assumptions need to be revisited and to develop new tools for a changing environment. And perhaps most importantly for this audience, research deepens our understanding and support of community banks. Through surveys, quarterly banking profiles, and work at the FDIC's Center for Financial Research, we study the unique role of community banks in their local economies. These insights shape how we inform policies, how we think about de novo applications, and how we assess the impact of new rules on institutions of different sizes. One example that illustrates how research and policy come together is deposit insurance reform. In 2023, after a period of turmoil in the banking sector, questions about the future of deposit insurance took center stage. Relying on prior research and extensive institutional knowledge, the FDIC was uniquely positioned to comment on the history and objectives of deposit insurance and the implications of alternative reform proposals. The FDIC responded by publishing a comprehensive report outlining different reform paths, and for each option, we carefully analyzed the benefits, the costs, and the risks. We asked, how would this affect depositor confidence? How would it influence moral hazard? And how much would each option cost the fund in the industry? Our goal was not to advocate for one answer. Deposit insurance reform is ultimately a legislative decision and is part of a larger framework of law and regulation. Our role was to ground the debate in evidence so that policymakers, bankers, and the public could weigh trade-offs clearly. The question remains timely. This morning's presentation on the Community Bank Survey highlighted that nearly 4 out of 5 bankers supported some type of deposit insurance reform, whether through higher coverage limits or targeted protection. Deposit insurance has served us well for more than 90 years, but changes in technology, the deposit landscape, and the concentration of uninsured balances all warrant a fresh look. Whatever path is chosen has the potential to shape the system for decades. The FDIC provides data, modeling, and policy analysis that clarifies the trade-offs and help inform sound banking policy. Deposit insurance reform is just one example of how research informs policy. The same principle applies to many other issues we're debating in banking today: supervision, mergers and acquisitions, new entrants, and the role of technology. These themes are not only central to the FDIC's work, they are also at the heart of this conference. And that brings me to the second part of my remarks: how research is at work in addressing today's most pressing banking challenges. And so far, I've described how research serves as the foundation of sound banking policy. But the real test of research is how it informs the decisions we face today, the policies we set, the supervision we carry out, and the priorities we advance to keep the banking system sound. Topics on supervision, M&A, entry of new banks, and the role of technology are central to the debates taking place in the industry, in academia, and among regulators. Research gives us a common ground to hold those debates. It helps us test assumptions, quantify trade-offs, and see risks and opportunities more clearly. Let me touch on a few of these themes today. I'll start with supervision. Supervision is at the heart of how we safeguard the banking system. But as recent events have reminded us, it is not enough to simply have rules on paper. Supervision must be risk-focused, timely, and effective. Research helps us understand how supervision affects outcomes, when it helps banks recognize problems earlier, how it can promote safe and sound banking practices, and where it may introduce tensions with fairness or burden. These questions are not abstract. They shape how banks experience exams, how supervisors allocate their attention, and how confidence is maintained in the system. We'll hear more about them in our next session on failed banks. and see them reflected in the ongoing conversations about how best to strengthen oversight in the light of past failures. As always, the real value comes from the dialogue between bankers, supervisors, and researchers about what does work and what doesn't. The FDIC, as part of its current agenda, is working to ensure supervision remains centered on core financial issues, such as capital, liquidity, interest rate risk, and credit quality. Research is a critical ally in this effort because it provides evidence that can help identify emerging risks sooner, allocate supervisory resources effectively, and evaluate the effects of exam practices. These insights help us strike the right balance: rigorous oversight that is fair, transparent, and constructive. Another topic where research is indispensable is industry structure, how banks enter, exit, merge, and compete. Questions of concentration, market power, and branch access are not just policy debates, they affect whether communities have meaningful access to financial services. Research helps us measure these effects more carefully: how deposit franchise value shapes competition, how mergers affect the availability of credit, how new entrants can revitalize local markets. We listened to a very insightful discussion on these topics during our first session, and we'll also hear from bankers' experiences at the panel tomorrow morning. On our end, the FDIC is reassessing its approach to merger review and committed to ensuring that de novo applications are considered in a timely and transparent way. But the broader point is this: decisions about mergers and entry are stronger when they're informed by evidence on competition, on community impact, and on financial stability. That is what research can provide. Perhaps no topic illustrates the intersection of research and practice more vividly than innovation and technology. Banks today face both opportunities and risks from technological change. Cyber resilience, artificial intelligence, and third-party vendor reliance are now central concerns. Research helps us understand these developments more clearly, measuring whether AI can improve credit outcomes, testing the resilience of payment systems, and examining the implications of open banking models. By relying on evidence, we can separate signal from noise, helping community banks adopt new tools and manage their costs and risks, without losing the strengths that define their business model. Finally, research informs many other areas of policy that are critical to the system's strength. These topics include calibrating capital requirements, analyzing fraud and payment system vulnerabilities, and adjusting regulatory thresholds to right-size the burden on smaller banks. In each case, research ensures that policies are proportionate, targeted, grounded in data, and responsive to the realities of different types of institutions. Taken together, these themes reflect questions faced not only by regulators, but by bankers and researchers. And research provides the bridge. It clarifies the trade-offs, informs the debate, and helps us move from theory to practice. Which brings me to the final theme I want to share with you today: the importance of partnership and open dialogue in making that research truly effective. Community banks are anchors in their communities, lending to small businesses, supporting households, and building trust that sustains local economies. The FDIC supports that mission. But no bank and no regulator succeeds alone. Partnership is essential. Bankers bring lived experiences and local insight. Researchers bring rigor and fresh ideas. Supervisors bring perspective from across the industry. And policymakers bring the ability to turn evidence and practice into rules and frameworks that endure. Each perspective is valuable on its own, but it is only when they are connected, when we listen to one another, test assumptions, and challenge each other constructively, that we achieve sound policy and strong outcomes. Dialogue is central to this partnership. The FDIC is committed to hearing from bankers, supervisors, and researchers. We seek public input on our proposals. We collect data and request comments on current processes we think can be improved. And through conferences like this one, we learn directly from each other. Dialogue improves policy because it grounds our work not just in models and data, but in the realities of those that we serve. Partnership and dialogue also create opportunity. They open doors for innovation that benefits communities. They allow us to anticipate risks sooner and respond more effectively, and they ensure that community banks continue to thrive, even as the financial system evolves. Let me close by once again thanking the conference organizers for bringing us here today for this important conversation. I'm honored to be here with you. The FDIC is committed to grounding its work in research, advancing sound banking policy, and strengthening community banking through partnership. But that commitment is only meaningful when it includes your voices. So please come find me and my 6 or 7 FDIC colleagues here during the conference. And I want to encourage you all, bankers, researchers, supervisors, and policymakers, to continue engaging with us. Share your experiences, share your evidence, and share your ideas. Because when we combine analysis with experience and policy with open dialogue, the result is not just stronger regulation, it is a stronger community banking system and a stronger overall financial system. Thank you.